I know I sound like a broken record, but the Dow, the S&P 500, and the Nasdaq are at record highs on the back of a weak jobs number. Well, let's try to figure this all out with Mannik Dhillon. He's the president of Victory Shares and Solutions. So, Mannik, let me first get your reaction to the jobs report number that we got today.
Well, thank you for having me today, Conway. My reaction is that I don't think we should be all too surprised. I think we were probably all expecting a better number, but then in the wake of the resurgence of the pandemic in certain areas and the anticipation of further lockdowns, I think you can reasonably see why some folks have put hiring and additional jobs and new jobs on hold. So I don't think it was in the end a complete surprise. And then also on top of that, you have the holidays, and that always creates a little bit of trickiness in interpreting the jobs numbers and the seasonality. So you look through it, and to see hospitality losing jobs and other areas that we are very economically sensitive. So not surprising at all.
Let's take the jobs number and put it into the whole stew, right? Because you got the vaccines that seem to be coming around the corner, stimulus talks, and now you got, clear signs that the economic recovery is slowing down. So what does that mean for investment strategy as we head into the end of the year and turn the corner into the new year?
Sure. And I think you said a little bit of it, right? You talked about some of the indexes hitting highs. You can tell that what the market is really waiting on and anticipating is really more stimulus. And stimulus, in addition to the potential of a vaccine that's going to hopefully bring people back to jobs, spending money, and all the other things that we were doing back in February and before. With that stimulus waiting out in the wings, I think there's some optimism in the market at least. And what we've seen as of late, and what should expect to continue, is the areas that are going to benefit from an economic recovery or reflation will be the ones that continue to benefit. We've seen small caps do really well versus their large cap peers. The large cap peers were the ones that have dominated since the downturn. We'll expect to see value-oriented companies do well into this type of recovery. You've seen that with energy today, for example, being up, in a sector of the market that was forgotten for a while. Yeah, but what's been interesting, really, Conway, is that we saw companies up until this point in the year, post the downturn, that weren't profitable, really doing well from a market perspective. And now, as we've seen the pivot from value to growth, we're also seeing unprofitable non-earners do really well. So it's a lot of the junkier names in that smaller and kind of cyclical parts of the market that have rebounded. But if you think about that going forward, it means that if your portfolio was concentrated in the more U.S. large mega cap growth oriented names, you probably want to step back and look at diversification and make sure that you're appropriately exposed to value, for example. The other thing is, if you look at where interest rates are and probably expected to be low, some of the things we're doing in our own portfolios is to look for diversifying sources of income. Can you get income in a way that is not correlated to, maybe your bonds? And then, especially with rates being so low, history's told us that your returns and your outcome in fixed income depends a lot upon where the yields are when you start. And so we're looking to areas like investment grade credits, corporates, where we have multi-asset portfolios that we manage.
Just as we were starting our conversation, I noticed that the yield on the 10-year note is just below 1%. It's at its highest since March. Do you expect rates to go up from here?
No, some of that, is obviously a reaction to people being back to risk on a little bit, right, and anticipating the reflation and the economic recovery, right. So you take capital out of there and you put it into the equities that we've seen being bought up in the last month or so and today. Overall, though, there is no reasonable expectation to see that the rates will increase in a material or meaningful way. Now, will the 10-year likely be higher next year at the end of next year? Probably by a little bit, but it's not going to be a situation where, a recovery where we're going to be back to normal so quickly that the Fed or policymakers are in a position to want to raise rates quickly. I mean, they've already come out and said expect to have rates stay low for a longer period of time. But that window of inflation at some point is going to come, and rising rates on the long end of the curve will come. and we'll see a steepening of the yield curve probably, but other than that, it's probably going to be a little bit more range bound.
So real quick before I let you go, I noticed that you mentioned energy already. Energy and financials are leading this rally today. So do you think that that is what the trend is going to be, that the economically sensitive cyclical stocks are going to lead the rally because we got all of this talk now of another stimulus package?
Well, I think it's reasonable to expect that if the stimulus, the bipartisan plan stays intact, comes to light or closer to fruition, we continue to see positive news from the vaccines that are coming to market and the supply chains there and the distribution plans. So what that does is it puts a light back on those cyclical area and those kind of downbeaten value-oriented parts of the market. And those sectors that you mentioned are exactly the ones that were almost left for dead in this massive growth rally that we've seen in the last year. So they are poised to do pretty well.
All right, great. Thank you. That's Mannik Dhillon. He is the president of Victory Shares and Solutions. I'm Conway G. Gittens, and this is Reuters.